Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, as always, publishes weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. So, Jeff, welcome back.
Great to be here, Mehdi.
So, we had a little bit of bounce in the market yesterday, but it feels like as we're filming this right now, we're rolling a little bit in the red. So, let's dive in as always with the top down from you, sir.
Yeah, last week was a tough week for the S&P, obviously down about 3% or so. We decided last week to do something a little bit differently, and we're not going to throw the slide in this week, I know, but we decided to approach the market from, kind of should we be bullish or should we be bearish, based on the pros and cons. This is an old Ben Franklin technique. He called it prudential algebra. When you list all the reasons to do something and all the reasons not to do something, it's not always precise as algebra, as he would say, but it does give you a pretty good basis for understanding the problem and seeing where the weight of the evidence falls. And one of the things that we determined was, if we really stretched our imagination and tried to come up with even ridiculous reasons why the market might go up, like world peace, for example, we could come up with a total of 15 different reasons why we should be bullish. But when we just listed the facts about what's wrong with the economy, what's wrong with the market, what the combination of these two functions would do for equity investors, we came up with 30, minimum 30 reasons to be on the sidelines right now. Not to be short necessarily, but just to really reduce net equity exposure, maximize cash reserves. And, we got a couple of things that investors are facing this week. We got GDP revision. We've got PCE and core PCE coming out on Friday. And, I think one of the big narratives that the entire bull market thesis hinges on is this idea that, inflation could go right back to 2% much sooner than most people think, and that the Fed will begin cutting next year. And we think that that's ludicrous. In fact, I think that most people are expecting a down core PCE on Friday, and I think one of the things we should definitely be concerned about is what would the reaction by the market be if, in fact, we got the opposite, a hotter than expected core PCE. We just saw a hotter than expected core CPI, and we heard some pretty tough hawkish rhetoric from Fed Chairman Powell last week. And so, I think those are things to keep in mind. You've also got a couple other issues evolving here. Number one, we're on the precipice of another government shutdown. We've been there before. It's not the end of the world. It gets worked out, but it creates a lot of uncertainty, right? And the other issue that I think is starting to weigh on people's view of consumer spending is the impact of the resumption of student loan payments. The average student loan payment is about $300 a month, and that's nothing to sneeze at. I don't think in this tightened consumer budget that's been affected by inflation. The other thing to consider is that about 60% of households, not individuals, but households, have a student loan that needs to be repaid. And so this is going to put a drag on consumer spending. I think higher oil prices, we've pulled back just below 90, but we've been hovering up around the $90 a barrel area for some time now. This is translating into higher gasoline prices. They've been averaging in the high 385 to 390 range. And that's another tax on consumer spending. That coupled with higher interest rates and higher mortgage rates, all these things are putting a lot of pressure on that 70% of the economy, the consumer spending portion of the economy, that is going to have an impact on earnings. And, the quarter's winding down here this week. We'll see third quarter earnings kickoff in a couple of weeks, I think, led by JP Morgan in the middle of October. And I think we're going to start to see, companies confessing, they're going to be confessing that they're not going to make their full year estimates. And we're going to see some downward revisions here as third quarter unfolds. So that's kind of what we're thinking, Mehdi. And honestly, what better advice could we give our clients than to just sit this one out, sit on the sidelines, reduce net equity exposure, maximize cash reserves, collect the equity risk premium risk-free in T-bills at 3-month T-bills, and just roll them until we get a little more clarity on where the market's going.
So sit on the sidelines and listen to the confessions is what I'm hearing here. So,
Exactly.
Jeff, we've discussed this before, but let's talk about the SKU Index. And I know you and Jim Struger did a special on this as well, with those alligator jaws, and we see it again here. It looks like it's starting to happen. Can you run us through like where we are like in this scenario?
Yeah. So how did we get here? Well, for months on end through, the end of July, we saw this decline in volatility and a lopsided demand for out of the money call options versus out of the money put options. And that caused the SKU index to trade up to very elevated levels. 100 on the SKU index is normal. That would imply that implied volatility has kind of its usual smile, right? But when the SKU moves up above, say, 145%, where we got to, I think, 158%, in fact, it starts to elevate the probabilities of a mispricing of risk in the market. And so, this demand for out of the money calls relative to out of the money puts pushes that SKU index out of its normal sort of smile for realized volatility. And once that euphoria that's driving the demand for out of the money calls subsides, you see a quick reversal in that back to more normalized levels. And we've seen it happen time and again, but not from such extremes, right? Where I think things differ this time is we got this sort of, new era sort of view because of artificial intelligence, which really pushed people's imaginations and allowed them to throw caution to the wind. And at the same time, we saw the VIX index collapsing, from, say the mid 30s down into the low teens. We got as low as 12.5%, which was a multi-year low. And I think from that level, we're starting to see evidence that reality and the reality of market risks, okay, are beginning to, just a more grounded view, if you will, of market risks are beginning to be priced in. And that's being expressed in this shift in the term structure of volatility. And what I mean by that is we're starting to see the VIX rally back up into the high teens. We've gotten as high as 18% here. And that kind of is resistance right now. If we break out above 18%, I think we see a quick trip to 24%. And, conversely, if we look at the SKU index, a breakdown below 130 could result in a quick trip down to 100, the normalized level. That would snap these alligator jaws shut. And honestly, when I think about the VIX, if we're going to go to 24%, there's no reason why we can't go to 34%. And if we're at 34% and things are really, that dire, there's no reason why we can't break out above the prior 2-year high of around 40%. It'd be my best guess that, in the event of some sort of a market event, if you will, we could very well see VIX soar into the mid to high 40% area as the SKU index collapses back down to 100.
And that'll be those jaws shutting slam shut. Jeff, can you also, we obviously had some mixed price action recently. We had the sell-off last week to a degree. Can you update us on your primary degree Elliott wave analysis?
Yeah, the big picture view, and we're just really showing, the daily price action dating back to the top in January of 2022. When we think about the decline, a lot of people feel like the bear market ended in October of last year. We think it just got started. We think that was the first wave of a 5-wave decline, an impulsive decline from that January high. We mark that January high as being the top of cycle wave 5, and by extension, the top of super cycle wave 3. And so we're going to be correcting a super cycle advance that took about 90 years to unfold. And that's not going to happen in 9 months with a 27% decline. In fact, we think that was the initial volley, and that the rally off of the October lows last year carried into July 27th peak, and that was the peak of primary wave 2. So we have wave 1 down ending October 22. We've got wave 2 up ending July of this year. And now we think we're in the early subdivisions of primary wave 3 down, which is just going to be the middle portion of this 5-wave decline. The thing to keep in mind, though, is that third waves are usually the most powerful, the most dynamic, and they have the most surprises, especially to the downside. And so it's our view that this decline could be something that would be particularly nasty. And, having said that, we've come up with a few targets by, really just zooming in on a shorter term view.
And I like this chart that you've expressed zooming in. Can you talk us through some of this as well? Because it's actually much more clear.
Yeah. So we've actually just kind of blown up that final kind of leg up into the July 27th high, and kind of looked at things from a minute degree and minor degree of trend perspective. And when we look at it at that level, we can see a classic pattern top formation of the head and shoulders variety, very, very evident in the price action. And the simple fact that we've taken out those June, August lows now resolves that classic pattern top to the downside. And if it does, continue as we would expect, it targets a level of S&P 4,050. And if that level is achieved, it would actually take out the intermediate wave A high from that primary wave 2 advance. And in so doing, it would eliminate any possibility of a bullish count. And by doing so, it absolutely definitively confirms that we are in the midst of primary wave 3 down. So where could that carry? Well, if we get to 4,050, we think that would probably be the end of intermediate wave 1 down of primary wave 3 down. We'd expect a counter trend advance to follow. And then ultimately, we would expect a third of a third wave decline. That third of a third wave decline could be very, very powerful, probably taking the market all the way down to, say, 3,200, which is, long-term trend support, right? But support levels are made to be broken. And when we're talking about a third wave decline, these are powerful declines with lots of surprises. And I think if we were to break through that 3,200, I think we could see a pretty quick trip down to the mid 2000s. And we've got an initial target of 2775 for our wave 5 low, which would terminate cycle wave A of super cycle wave 4. Now, let's just say we get there. What follows? Well, we would expect a very significant counter trend advance to follow. So we're kind of sitting back and waiting for this to play out, because we think there's going to be a much, much better buying opportunity for long-term equity investors down in the mid 2000s. That 2775 is actually the high end of the range that we're forecasting. We think it could be as low as, say, 2450. And ultimately, we think cycle wave A, the entirety of this 5-wave decline, once it's complete, could end around S&P 2250. So that's really the area that we want to get super aggressive on equities for a bounce that could be something like a 50% retracement of the entire decline.
Jeff, I feel like we should start having some of those beeps pop up whenever you're talking about some of these levels, like just to shut it out, because it's all very quiet. It's all very scary. Speaking of scary, let's look at the market internals.
Market internals continue to be very weak. I mean, they collapsed essentially over the last week or so. I'd draw your attention to the middle frame of this chart. That's momentum. We like to look at the 5-week RSI oscillator as a measure of intermediate term momentum. And that momentum has rolled over from a lower high, which left a negative divergence in place last October, plunged through the median line, rallied back to a lower high again, and plunged again. We're still holding above oversold, though, which tells me that momentum is not oversold and that we have more downside. We could get quite oversold and stay there if this is a third of a third wave decline in our headlights. And so I would not look at oversold momentum as a reason to buy, right? Because I think you're just on the wrong side of the trend at that point. Now, if we look at breadth is exceedingly negative right now. And this is just S&P 500 breadth. If we look at the broader market, I mean, virtually the entire market is in very, very poor standing. I mean, below fewer than 50% of the stocks in all U.S. stocks, that is, are below their 200-day moving average at this point. I mean, that's not a condition that it lends itself to a bull market, okay? Something like 40% of the stocks in the S&P are negative year to date. So, I mean, this is not bull market statistics, right? These are the sort of readings that you would note occur in the midst of a major bear market. And that's where I think we are. If you look at net advancing volume, about 32% of volume last week was positive. Again, not bullish. But what's more important is if we look at the 5-week moving average of advancing volume to declining volume, that's up versus down. We're at about 1-to-1 right now. That is not a condition that is conducive to a sustained bull market, right? You want to see up volume at 5-to-1, right? 5-to-1 net advancing volume on a 5-week moving average. That would suggest to me that we've got a durable bull market intact, right? What this is telling me is that we could barely muster up a single stock to go up for every one that goes down. And that's just not something that lends itself to a bull market.
So, Jeff, just looking at the investor sentiment side, it looks like it's pretty much a nothing done, or is there anything worthy of mention here? It's kind of just more of a point of inclusion, really.
Well, you know, extremes are really where we get the best reaction, right? From sentiment, like when we were leveraged at 101% in late July on the name exposure index, that was a clear indication that things were reaching an extreme, right? And that we should position for a reversal. Well, we did get a bit of a reversal, but where are we? We're dead center, 55% net equity exposure for the name exposure index is neutral. We're at 54.3, right? So, I mean, that's dead neutral from a professional investor's, net exposure. If we look at the individual investor survey, the American Association of Individual Investors, AAII, that is a little bit more on the bearish side, but this is a notoriously bearish cohort to begin with, right? They're very rarely ever bullish. What we saw, say, just a week ago was the bull minus bear spread was at 12.5%. That has pulled back to minus 3.3%, a level that, you know, certainly come down significantly, right? 15 points. But this thing got to negative 42% in October of 22. So we're basically at the midpoint, and it would be more of a neutral reading with maybe a slight downside bias at this point.
Right. And the Magnificent Seven, or, you know, I guess the less Magnificent Seven almost.
Well, you know, this group got pummeled last week. There's no question about it. Tesla was down almost 11%. Apple was flat. Okay, that was the best performing stock of the Magnificent Seven group, right? To come in just slightly negative. I think it was down like minus 0.1%. You know, so we'll call it flat to be generous, unch. But at the end of the day, I mean, all these stocks were down significantly, and it was, you know, the more AI you had to you, the more likely you were going to be down double digits, right? And so, you know, Tesla, Nvidia, you know, they got hammered. I can't remember the exact order off the top of my head, but suffice it to say, a sense of reality has now overcome investors, and they're now looking at the valuations of these names. And I am frankly a little surprised that Apple held up as well as it did, because of all the stocks that we're talking about here, that's the one that I have the most difficult time justifying its valuation, right? It's not growing, okay? It's actually got product problems and manufacturing geography problems. There's some big fundamental issues going on at Apple, and I think to pay 30 times or close to that for next year's earnings is really aggressive, put it that way. Tesla at least is growing, right? I think it's overvalued, but it's growing. Nvidia is growing. It's overvalued, but it's growing. So I think these stocks are going to come back down to earth. I would suggest that at minimum we could see the 200-day moving average tagged, which in the case of Nvidia is some 25 percentage points below where the stock traded last night. So, I would not be too excited about getting long these names.
I also think that Apple, just last week being a special case because they had their launch of their iPhone 15 models and some of the new earbuds and whatever. So I think there was a lot of positive headline news, which probably helped prop them up for a day or two.
Yeah, that's fair. Absolutely.
Any standout sectors last week, Jeff?
Well, energy continues to be the sector that catches our attention more than any other. Two reasons. Number one, valuation is exceedingly cheap relative to everything else in the market, whether it be small cap, mid cap, or large cap. Right. The flip side of that would be technology, which is extremely overvalued relative to everything else. So we've got this. This dynamic in the market where investors are paying any price for growth, and the only place they can find it is in the tech sector. And that growth is actually quite fleeting. You're not seeing it in semiconductors. As I mentioned, you're not seeing it in Apple. But they're willing to pay up anyways, to bet on the come because of the entire narrative built around a potential AI revolution in the future. We've commented on this before. We think AI is real, but we also believe that it's in the very first innings of the game. And we're going to see the real results, 10, 15, maybe 20 years down the road. And right now, what we're seeing is the enthusiasm of investors toward that. So, that being said, our bias is really to focus on stocks that have a decent margin of safety, right? And that would be energy in our book.
Right. And the relative strength analysis is telling the same sort of picture.
The momentum's outstanding for energy, and it's deteriorating sharply for tech, communications, and discretionary. I think that this rotation into the leading quadrant in energy, be it large cap or small cap, is sustainable. And as long as oil prices remain in this elevated state, and I don't see anything that's going to change that, right? We've got production cuts in the Middle East, and we've got worldwide demand hitting new all-time highs, and U.S. inventories at 45 days versus, I think, 46 days versus an average of 65 days. We're at 40-year lows anyways in terms of inventories. None of that points to lower crude prices anytime soon. And in our opinion, higher crude prices are going to sustain this energy momentum. And so I think we're in pretty good shape from a relative strength perspective.
So, Jeff, obviously every week you do publish, 5 longs, 5 shorts in the top actionable trade ideas. That is for paying customers, as we've discussed before. But can you give us a little taster here today? Because there's so much going on. It'd be nice to get maybe one idea, long, short.
Yeah. Sure. My top long idea this week is Valero, VLO symbol. Stock broke out from a classic double bottom base formation. The breakout above 144 counts to about $195 a share. I'd set a stop loss at 135 to protect capital. and it gives you a pretty good 3-to-1, positive risk skew.
Great. And what about something on the short side?
Well, if energy prices are going to remain high, I think those costs are going to flow through on the transportation side. And no stock looks like it's more ready to keel over from that than UPS, United Parcel. This is a stock that is, breaking down below the neckline of a classic pattern top formation of the head and shoulders variety. It's a multi-year top formation. The breakdown below 155 if sustained counts to about $80 on the downside. We would set our risk budget to 167 to set up a very nice 3-to-1 positive risk skew.
Great, Jeff. Thank you so much for sharing your thoughts. Really appreciate talking talking stocks with you, and obviously your thoughts from Alpha Insights. And also, don't forget to sign up to Substack, hugeinsights.substack.com. Jeff, thanks again, mate.
Always a pleasure.
Until next time, thank you for watching. Good luck investing.